Do you want a simple one-fund portfolio? If so, should you put everything into a global stock fund like I do, or spread your money across different types of investments? Many investors ask whether it's better to chase high returns with stocks or play it safer with a more diversified mix like a LifeStrategy fund. In this video, we'll look at the pros and cons of both approaches so you can decide what's right for your money. This video is sponsored by Lightyear, a UK investment platform with low and transparent fees that offers stocks, funds, and interest on uninvested cash. Let's begin with the difference between the two approaches. If you have a global equity fund, and here's a list of them, then essentially you're buying the same thing, which is a slice of the global equity market. Now, you won't buy the entire equity market. Not all of it can be bought by retail investors like you and I, but you will end up buying about 80% of it. And nowadays there are lots of choices about which fund to buy. There's a lot of competition between fund managers to offer low-fee global funds. So here you can see a selection of them, and you can see that the fees generally tend to be quite low. All of the ones on this list are exchange-traded funds. One of them is an open-ended investment company, but really what matters is the index which they track. And the popular ones would be the MSCI All Country World Index and also the FTSE All World Index. But whichever one you choose, you'll find very similar returns and very similar risk. And that's because there's only one world's worth of stocks that you can buy. In contrast, if you buy something like a LifeStrategy fund, what you're doing is buying a mixture of global stocks, but also global bonds. So not only are you diversifying across the equity market, you're also diversifying across the bond market. So in that sense, you're much more diversified. Stocks tend to have high correlations within the asset class. So do bonds. But when you combine the two, magic happens and you get better risk-adjusted return. And we'll dig into the meaning of that later in the video. But really what it means to you as an investor is that you can dial the risk up or dial the risk down according to how much you've got split between equities and bonds. Equities give you high long-term return, but they're very crashy, whereas bonds give you lower return, but tend not to be so crashy. Now in this video I'm going to use LifeStrategy as the example for multi-asset funds. It certainly isn't the only family of multi-asset funds that you can buy. For example, HSBC offers a similar range of funds graded by risk. iShares also offers one of these risk-graded family of funds. But since 2011, Vanguard has pretty much stolen the show when it comes to these low-cost multi-asset funds that give you exposure to a diversified portfolio with just a single investment. Now in a moment we'll go on to talk about the benefits and drawbacks of each type of fund. But first, this video is sponsored by Lightyear, a UK investment platform with low and transparent fees that offers stocks, funds and interest on uninvested cash. A few months ago, I visited Lightyear's office in London and had an amazing chat with their team, especially about fees and safety. Off the back of that conversation, Lightyear's now made their stocks and shares ISA completely commission-free, something I'm genuinely excited about. Fund manager fees and a 0.35% FX fee may still apply. They've also gone through a recent rebrand, keeping the same award-winning user experience, but with an even more premium look and feel. And to top it off, Lightyear recently raised $23 million in Series B funding from top European investors. And this will allow them to keep improving and expanding their platform. If you're looking for a transparent, easy-to-use investment app with one of the best user experiences out there, Lightyear's definitely worth checking out. You can try Lightyear using the code PensionCraft or follow the link in the description to get up to $115 worth of a US fractional share in your general investment account. Terms and conditions apply. See the description for details. And remember, investing involves risk, and the value of your investments can go down as well as up. So now let's go through the benefits of a single global equity fund. Now, one of the primary benefits is low fees. And there's so much competition between fund managers now that you can see that the fees that you'd pay would be very low indeed. The cheapest global equity fund I know of has a fee of just 0.07%. But you can quite easily find one of these funds which has a fee of 0.15% or less. And these fees are likely to carry on falling in future. Secondly, it's a well-documented fact that over a long period of time, stocks give you much better rates of return than bonds. So here we're comparing LifeStrategy Funds with ACWI, which is a global equity index fund. Notice how as we go from 20% equity in LifeStrategy 20 up to 100% equity for LifeStrategy 100, gradually the rate of return increases. Now that comes with more volatility. The LifeStrategy 100 line is much more wiggly. And then the line you can see at the top of the graph is ACWI. Now later on we'll talk about why ACWI, which is a global equity fund, has outperformed LifeStrategy 100, which is also a global equity fund. But for now, just take a look at that table of annual returns and look at that relationship between the amount of equity, the amount of bonds, and the annualized return. And that's for this period since 2011. Another benefit of a global equity fund is that it's diversified-ish. It's diversified because it buys stocks from all over the world. So it's certainly diversified across countries, but also across different sectors, such as tech, healthcare, communications, utilities, and so on. Earlier, I mentioned two of the largest index companies, that would be MSCI and FTSE Russell. So if we compare the MSCI All Country World Index with the FTSE All World Index, both are global index funds, you can see that both of them contain thousands of stocks. There are more than 2,500 for MSCI and over 2,200 for FTSE All World. So why did I say diversified-ish? Well, now we come on to the first drawback of a global index fund, which is that at the moment it is highly concentrated in just a handful of stocks, which is a very unusual state of affairs. To go back to this level of concentration, we'd probably have to go to just before the dot-com bubble burst. Now the current concentration is in US tech stocks. So even for this global equity index, and here's the composition for the 10 largest holdings of MSCI All Country World Index, a quarter of the index is in just these 10 stocks. Now that's a result of the success of the stocks at growing their profits, but also their share price. However, if there is a drawback in this very narrow leadership of this global index, that could potentially draw down the whole index quite sharply, more so than we'd expect usually. And that brings us to the ugly side of global equity index funds. And that, of course, is their crashiness. Here what we're looking at is the percentage fall from the previous all-time high. And this is for that ACWI fund again. Now, if we plotted it for any of the other index funds that we saw at the beginning, you'd see a very similar pattern. Now, over this period since 2011, you can see that there have been 5 quite sizable crashes. So if you are going to buy a global equity index fund on its own, then you really should be comfortable with this size of crash, or one which is even bigger, because it's going to happen. And that's why this may not be suitable for you. If you're not comfortable with your portfolio falling dramatically, if you'd be someone who'd panic and sell if that occurred, rather than seeing it as what it is, which is a sale, then 100% equity is clearly not for you. And the time to work that out is before the crash happens, not during a blistering rally. So just be realistic about your appetite for risk and visualize a 20 or 30% fall and think, would I be comfortable with that? Now let's look at the benefits and drawbacks of LifeStrategy. Now we saw that LifeStrategy is risk graded with 20% equity, 80% bonds, then 40% equity, 60, 80 and 100% equity. What I've shown here is LifeStrategy 60, which is the most popular variant of this family. While it does have 60% equity, even within that asset class, you can see that it's split up into different regions. So we've got Developed World X UK, we've got a US index, we've got a FTSE All Share Index, we've got Japanese equity, and also in the bond space, we've got multiple bond funds. So not only is this diversified across asset classes, it's also diversified within those asset classes. And that means that when there is an equity market pullback, most of the time the bonds will cushion that blow. So if you're someone who's not comfortable with those losses that we saw for equity, then maybe you should consider LifeStrategy 80, 60, 40, or even 20. Over the long term, there's a penalty to pay for that lower risk, but it's worth it if you're going to sleep at night. Another benefit is that it rebalances daily. The reason why rebalancing is important, if you buy LifeStrategy 60 and equities rally strongly, well, suddenly the equity component will increase. So what started out as LifeStrategy 60 would end up as LifeStrategy 65, say. But that's not what you wanted. That's too much risk. So what Vanguard does on a daily basis to address that problem is they sell whatever's gone up relative to what's gone down. So let's say that equity rises more than bonds. Well, in that case, they'd sell some equity and they'd buy some bonds. If bonds have risen more than equity or equities crashed and bonds haven't, then they'll do the opposite. They'll buy some crashed equity by selling some of the bonds. Now, this is great for people who are starting out in investment because it's often quite scary to sell things and buy things to know you've got it right. So this is a very low maintenance approach to investing, and you really don't need to fiddle with this fund at all. Once you've bought it, you're pretty much done. Now, I said that these LifeStrategy funds are risk graded. Let's see what that means in practice using one of these drawdown plots. And you can see that when there is a big equity market pullback, so for example, if we look at 2020, you'll see that LifeStrategy 20 only fell about 10%. And that's because equity fell much more than bonds. Compare that with LifeStrategy 100, well, that fell by over twice as much. It fell by 27%. You'll see a similar pattern if you look at the crash due to the tariffs in 2025. LifeStrategy 100 fell much more than the other LifeStrategy funds. The big exception to that was 2022, when stocks and bonds fell at the same time. Now, usually bonds diversify stocks. In this case, however, inflation was spiking, interest rates shot up, and equity and bonds fell together. So in this case, the diversification benefit of bonds was non-existent. But we'll come back to that in a moment. Now let's get on to the drawbacks of LifeStrategy. And here I've got LifeStrategy 100. Remember, this is the one which is a global equity fund in effect. It has no bonds in it whatsoever. But it has a very large amount of UK equity in it. I've highlighted here the 3 UK equity funds in LifeStrategy 100, and their weights add up to just under 25%. Now, if we take a global equity index fund, another one, like ACWI for example, the UK weight is just over 3%. And that's because the UK equities market capitalisation is absolutely tiny. It's comparable with some of the largest single stocks on the US stock market, in fact. Now, why does Vanguard have such a huge 7-fold overweight for UK stocks? Maybe it's to do with familiarity. It's easier to market these funds to UK investors if they see a fairly large UK allocation. However, historically, it's been a drag on return because UK equity markets have massively underperformed US markets. Now, that doesn't necessarily mean they'll underperform in future, but many people dislike the huge UK overweight for these LifeStrategy funds. It has to be said, other multi-asset funds like the ones from HSBC don't have this overweight. So this is something specific to Vanguard's LifeStrategy funds. Now, if you do go for anything other than LifeStrategy 100, there will be some bonds in your portfolio. And as we've seen, that usually reduces your long-term return. So always remember that trade-off. If you do want higher long-term return, you have to live with greater risk. If you do want to dial down the risk, then you dial down the return. And if we compare the fees on LifeStrategy funds, you can see that the annual ongoing charge is 0.22%. Now that's comparable with Vanguard's VWRP fund, which is a FTSE All-World fund. That is a global equity tracker, but is significantly more expensive than many of the other funds which you can see here. Now, LifeStrategy funds are funds of funds. They're made up of other Vanguard funds, as we saw previously. Now, by choice, Vanguard has no commodity funds. So if you wanted exposure to gold, Vanguard doesn't provide a fund to do that. Why is that a problem? Well, many people think, and there is evidence to show, that including things like gold in your portfolio can make it less crashy. In that example in 2022, when stocks and bonds fell together, well, gold would have allowed your portfolio not to crash as much, because gold didn't crash. In fact, what I've done here is to create a very simple portfolio, which is 50% global equity in the form of ACWI. I've also got a UK government bond fund that makes up a quarter of the fund, and the remaining quarter is in gold. Now, what's remarkable about the return of this fund is that it's greater than that of LifeStrategy 60, and that's even though it's only got 50% equity. Part of the reason for that outperformance has been the very recent performance of gold, which has been spectacular, but also during that crash in 2022, this portfolio didn't crash as much because gold provided a support. So I think if Vanguard were to add a commodity like gold to their platform, presumably they could also include that in LifeStrategy Funds, and that might be to the benefit of their investors. Now let's compare the two options based on return and risk. So here's a risk-return plot where we've got risk on the x-axis with high risk on the right, low risk on the left, and return on the y-axis. So high return at the top, low return at the bottom. Notice that the LifeStrategy funds form this beautiful arc going from low risk, low return to higher risk and higher return, showing this risk-return trade-off beautifully. I've also superimposed the MSCI ACWI fund, the 100% equity fund, on this graph. And it fits quite nicely in the risk-return curve for LifeStrategy. You can see it's a little bit more risky than LifeStrategy 100, but it also has a slightly higher return. Now, because of this risk-reward trade-off, one way to look at investments is to say, how many units of return have I generated for every unit of risk which I've taken? So if we take the return of a fund and divide by its volatility, which is one measure of risk, we get this measure of something called risk-adjusted return. So how do the funds that we've discussed so far measure up based on these risk-adjusted return measures? Now here I've shown two different measures of risk. The first one is simply volatility. If we take the return of each of those funds, subtract the risk-free return, which I've taken to be a money market fund's return, and then divide by the volatility of the fund, that gives you what's called the Sharpe ratio. It's the excess return above the risk-free rate divided by the volatility. I've also shown another measure, and instead of using volatility in the denominator, here we're only looking at downside deviation. So we don't care about up crashes, we only care about down crashes. And this is more in tune with our intuitive feeling about risk. And this is called the Sortino ratio. Now what's kind of surprising here is that LifeStrategy 60, which has neither got too much risk or too little, has the best risk-adjusted return. And maybe that's why it's the most popular fund in LifeStrategy's lineup. And that's true for both measures of risk, Sharpe ratio and Sortino ratio. But what if Vanguard were to take my advice and introduce gold into their fund lineup and put it into their LifeStrategy funds? Well, suddenly you can see the benefit of gold, certainly for the Sortino ratio. Here you can see that it's got a much better risk-adjusted return than any of the other LifeStrategy funds, certainly over this period since 2011. And remember, that's such a simple portfolio. 50% global equity, 25% UK government bonds, and 25% gold. And just so I don't do a disservice to LifeStrategy, a lot of people say that if you do have a larger UK equity allocation, a larger domestic allocation of up to 40%, then that actually helps you long term. And certainly if we look at the returns year to date, you can see that LifeStrategy 100, with its big UK overweight, has outperformed ACWI. Not hugely, but certainly it's outperformed. Now, will that continue? I'm not so sure. I've certainly got a UK overweight in my portfolio, a small cap one, but it's nowhere near as large as the ones in LifeStrategy. But at least it's nice to see that UK equity is finally doing pretty well. So let's wrap up by looking at which fund might be best for you. Personally, I think that LifeStrategy is probably best for most people. Although I'm someone who has 100% equity, my circumstances are quite unusual. I own a company and I may not retire for a very long time. So it may be that I don't actually need my invested money, which means that it has a very long investment horizon. For most investors, they do have to think about risk because their horizon may not be the same as mine, their risk appetite might not be the same as mine, and their risk capacity, which is their economic ability to weather a loss, may also not be the same as mine. So by choosing a LifeStrategy fund which has the right risk grading from 20% up to 100%, I think LifeStrategy works for most investors, particularly ones who are new to investing. Furthermore, the automatic rebalancing of LifeStrategy stops you fiddling with the weights, something which even I'm prone to, and it also ensures that your risk doesn't vary over time by that constant rebalancing process. And although in 2022 the diversification in LifeStrategy broke because equity and bonds fell at the same time, that was the largest fall in bond markets in living memory. For most crises, it's the case that bonds are a fairly good hedge for equity. And in turn, that means that LifeStrategy can weather what markets throw at it most of the time. But for some investors, I think a single global equity fund can make sense. For example, if you're very young, then volatility and crashes are an opportunity, as long as you're comfortable with that risk, if you can educate yourself to see risk that way. Because when equity markets fall, it's a bargain, it's a sale, and it boosts your long-term return if you buy more equity at depressed prices. And that's because eventually it recovers, and if you have a long investment horizon, you can monetize that gain. For sophisticated investors as well, I think a single global equity fund can make sense. And that's because you may have other investments, maybe it's a buy-to-let property, maybe you've got a defined benefit pension, or, like me, you've got a business which is very cash generative, or you may simply have an excess of savings. You might be very wealthy, in which case you probably won't touch most of that wealth over your lifetime, in which case volatility is not so important. You may be thinking about your legacy and leaving some of that money to your family, or it could be left to charity. So in that case, you'd also want to maximize growth. And then finally, one of the problems with LifeStrategy is that if equity markets do crash and you're in retirement, well, you're having to sell something every month to generate an income. If you've only got LifeStrategy in your portfolio, you have to sell the crashed equity alongside the uncrashed bonds. That means you're not making use of the fact that the bonds haven't crashed. If you had split up your portfolio into a global equity fund and safe investments like gold, cash, short duration government bonds, well, in that case, you could sell the things which haven't crashed and wait until equity markets recover. And that way, you can lengthen the lifetime of your investment pot. So I think LifeStrategy in retirement reduces your optionality, and that can hurt your long-term performance. So hopefully that's helped you understand the benefits of my approach, which is a single global equity fund, and a more diversified approach like LifeStrategy. A single global equity fund offers very low cost and very good growth potential, but it comes with crashiness, whereas LifeStrategy provides better risk-adjusted return. It's also rebalanced automatically, and maybe it's worth a higher fee not to have to do those things for yourself, certainly for people starting out in investment. Now don't forget the offer from the sponsor of today's video, which is Lightyear. If you use the code PensionCraft on their website, or you can follow the link in the description below, you can get up to $115 worth of a US fractional share in your general investment account. Terms and conditions apply. See the description for details. And, as always, thank you for listening.